Hello. Now we'll talk about interest rate futures. Okay. So these contracts are very similar to the forward contracts we discussed in the previous videos. So it's again a contract between two counterparties. One counterparty agrees to buy a given bond on a future date at a given price, and the other counterparty agrees to sell that same bond. Okay. But there is a little bit of a twist here because in some of these futures contracts, the underlying is indeed a bond, but in some other futures, the underlying is not really a true bond, is an artificial asset that is just designed to look like a bond, but it's not really a bond. Okay, but we'll get to the details later on. Right, so what are the main differences between these futures contracts that we are looking at now and the forward contracts that we looked before? So the first one is that futures are exchange traded, meaning that when I trade a futures contract, I am trading with the exchange directly. Okay. The futures are standardized. This is both good and bad, but it's mostly good in the sense that the standardization creates a lot more liquidity in these contracts. The downside is that it is no longer tailor-made for my needs like a forward contract could be. A third difference is that futures are marked to market every day, meaning that every day we compute profits or losses, and we have to pay those profits or losses. So at the end of I start a position in a futures contract, and at the end of one day, I have to settle the profit or loss, and the cash flow is computed as we defined in the forward contracts. It's the price that I started the futures, and this is the price at the end of the day. So it's replacing the B in the previous formula for the forward contract. Okay. If I hold a position, the futures position until the end, I have this stream here of cash flows that happen every day. So this will be for the first day, the second day, and so on until the last day. And I can see that these terms here mostly cancel each other out. So this is the futures price at the end of the first day that cancels with this one that refers to the second day. This F2 would cancel with the next F2 and so on until the last day. This F would cancel with the previous one. So I would only be left with the initial futures price at time zero and the final futures price, which has to converge to the bond price at the maturity date of the futures. So if I hold until maturity, this final payoff, which is the sum of all these intermediate payoffs, looks exactly like the payoff in a forward contract. Okay, so typically we in most other markets we just ignore all these intermediate cash flows and say, well, it's exactly like a forward contract. Here in interest rate futures, we will not be able to totally ignore this. So later on we'll have to come back to this idea here and see what is the effect that this has on interest rate futures. Okay. A fourth difference is that in futures there are margins that we need to post with the exchange, and this is good in the sense that it reduces the credit risk of the market. Okay, there are several types of interest rate futures. We split them here on two groups: futures on short-term interest rates. We're going to look at one of the most important one, the most traded in this market, which is the 3-month euro-dollar futures. And then there is a second group on long-term government bonds. Okay, and we will look also to one of the most important contracts that represents this category, which is the U.S. Treasury bond futures. Right. One more note about the relation between the futures price and the forward price. The main idea here is that the forward price that we determined in the previous video is a reasonably good approximation to the futures price. Namely, if these assumptions here hold, then we have exactly equality, meaning the futures price would be determined exactly like we did in the previous video for a forward price. Okay. In reality, these assumptions do not hold exactly, so we don't have this exact equality here. We have just an approximation.